I'm going to introduce you to your keynote addresser, a man who rocked up here, and he's looking very dapper today. He always does, I'm told. The disruptive potential, innovation, and regulation within the crypto industry. Please put your hands together for Wiehann Olivier. Thank you very much. I'm so glad you work for Mazars and not KPMG. So it's good to see you up here.
Thanks so much.
All right, Wiehann.
Appreciate it.
Floor's yours.
Thank you so much for joining us here today. For those that do not know me, my name is Wiehann Olivier. I am an audit partner and digital asset lead at Mazars South Africa. And what we're going to be discussing today is the disruptive potential, innovation, and regulations within the crypto sector. Specifically focusing on South Africa, but we'll have a look at it on a glance on an international level as well. So those that are not familiar with Mazars, just a brief introduction. We are an integrated local and international audit firm. We operate over 9 offices in South Africa, and we operate over 90 countries and jurisdictions throughout the world. We essentially service those in the virtual asset service, or the digital asset and cryptocurrency sector through our financial services division that covers banking, insurance, asset management, and of course digital assets as well. So we've got a dedicated digital assets team specifically dealing with virtual asset service providers and the retail customers as well. We've also got fair involvement in a global level, of course, Mazars being an international firm. We've assisted our various offices internationally on working on virtual asset service providers internationally. Myself, I work with the Singaporean office, with the UK, with the US, with Bermuda, Caymans, Germany, all over the show. Interestingly enough as well, we work with the US office on a specific engagement, which forms part of one of the 5 largest cryptocurrency exchanges in the world by volume. Very, very interesting from that perspective. In South Africa, of course, we service the leading and largest virtual asset service providers with our variety of services. Now, of course, the services that we offer includes audit and assurance, that includes statutory audits, it includes proof of reserve reports, it includes Oracle services, accounting services we do for some of our digital assets service providers, virtual asset service providers. We do some tax and consulting work. Of course, we'll touch on a bit of tax and consulting as well today because that tends to be one of the more contentious areas when dealing with cryptocurrencies. We also do consulting, general consulting, structuring consulting. We also do treasury functions, sustainability reporting. Our corporate finance department, of course, do valuations on these virtual asset service providers and also assisted with due diligences when corporate institutions invest into these virtual asset service providers. And of course, fortunately or unfortunately, we also deal with this on a forensic services level as well. So the first topic that I want to discuss today is regulations in South Africa. And I know this is a contentious topic that has caused a lot of frustration in South Africa as well. But essentially, if you look at the different approaches that the various countries are taking on regulation, so there's essentially 3 approaches. There's the outright ban, as we saw with the likes of China that imposed a blanket ban on anything cryptocurrency related. And then you get the route of trying to regulate it from the get-go, as we saw with the BIT license in the state of New York as well. Fast forward to today, of course, and those virtual asset service providers operating from the US try to work around the state of New York as a result of those incumbency laws and regulations sitting there. And then, of course, it brings us to the final approach, the look-and-see approach. So that's been applied by regulators in Singapore, the UK, and to a certain extent, South Africa as well. So they want to see how cryptocurrency moves, how this asset class fits into the financial sector before trying to regulate it. So, of course, from that point, we ask the question is, where's regulations in South Africa in terms of the digital asset space as well? So if we rewind back to November 2020, the FSCA released a position paper specifically dealing with cryptocurrency and classifying as a financial product. From my perspective, I was expecting to see regulations kick in about 12 months after that. But of course, November 2021 came, no regulations. Earlier this year, we heard it's another 12 to 18 months before regulations kick in. So it's still a way to go. And we're asking ourselves the question is, why is this taking so long? And I think you need to understand that these rules and regulations are intertwined to a certain extent as well. And it has a knock-on effect to other laws and regulations and also from a practical point. So that's what's creating this difficulty in setting these laws and regulations. But of course, the big question is what needs to be done? So the steps that needs to be taken is essentially the FIC needs to be amended to declare cryptocurrency as a financial product. The FSCA needs to develop a regulatory framework. The SARB needs to finalize the exchange control regulations. I mean, that's one of the contentious areas. If everyone dealing in the crypto space, what we want answers on is what's happening in terms of the exchange control. And from my point of view, I'd like to see how they are going to implement what they're proposing from like a practical point of view to make this actually work. Of course, the FIC needs to finalize their KYC, know your client, and anti-money laundering procedures. And of course, one of the other areas that I dropped in there is just regarding SARS guidance, because we'll touch on this today, but this is something that we need more guidance on. It's not just corporates, but you sitting there as individuals investing in cryptocurrency, you need to know what your tax obligation is. So the big question is, why do we need regulations in South Africa? Well, case in point, look what happened at Mirror Trading International and AfriCrypt over the last couple of years. We essentially need that consumer protection that will ultimately lead to mass adoption in cryptocurrency, not only in South Africa, but also internationally as well. We need to legitimize the cryptocurrency and digital asset sector and alleviate all the scams taking place using cryptocurrency. Of course, everyone's got this stigma that cryptocurrency is used for scams purposes. It's just the case that individuals don't necessarily understand the technology, making them susceptible to individuals that's scamming them with their cryptocurrencies. And of course, one of the key areas where I'm also very excited about is the innovation. Regulations will bring new innovation. We will see for the first time listed securities holding digital assets as the underlying asset. And of course, being traded freely on the open market, such as on the JSE. And we've also seen this roll-on effect of collective team of investments with the Tax Act, and we'll see new products coming from there. But at the bottom of the slide, I've got something that is extremely important and I want you to take note of. And those others in there, or out there that are the regulators as well, is digital assets such as cryptocurrency remain an unregulated asset class. Only the asset class is unregulated. Those virtual asset service providers that are either exchanges, investment platforms, OTC desks, arbitrage businesses, they are currently regulated. They're regulated by the Companies Act, the VAT Act, the Income Tax Act, the Exchange Control Act, and the list goes on. There's already so much regulations applicable to them. And to those virtual asset service providers, I also want to slot in this final idea there. It's just what non-compliance could possibly mean for them. So virtual asset service providers need to make sure that they adhere to all of the current laws and regulations in play before new laws and regulations are being imposed on them. Because as soon as the new laws and regulations come about, they're going to have difficulty catching up or playing catch up with the existing laws and regulations out there. And of course, that's going to impact them operationally. And when it impacts them operationally, it impacts their consumers and their customers, which are you guys sitting out there. So extremely important to note that. So one of the areas that, when I spoke previously at the Crypto Fest, I spoke a bit about accounting as well. And I could see immediately everyone was bored when I spoke about accounting. So I do want to discuss this topic just briefly, so you can gain an understanding of exactly why this is important, to educate yourself, to ask the right type of questions. So basically, in South Africa, we predominantly use international financial reporting standards. In the US, we use US GAAP. But essentially, these are rules for us to compile financial statements within. Now, in the background, over the last probably 3 to 4 years, there's been a lot of debate going on as well in terms of this contentious topic of on and off balance sheet accounting. To give you an example, if you go to a cryptocurrency exchange today and you deposit 100 Rand with them, you'd expect to see on their balance sheet 100 Rand of your cash sitting there and a corresponding liability of 100 Rand owed to you. Now, in certain circumstances, you are able to argue that that asset and liability shouldn't be shown on balance sheet. It should actually be shown off the balance sheet of the virtual asset service provider. Now, for the most part, our clients within Mazars, we've argued always that this needs to be on balance sheet because there's an element of accountability there and at play. Interestingly enough, even though there's this possibility to argue off balance sheet accounting, the European Financial Reporting Advisory Group, also known as EFRAG, came out in 2021 and they said, well, we're looking at this topic of on balance sheet and off balance sheet accounting. When looking at it, the issue is that when you custody someone else's asset, you actually need to show that asset liabilities on balance sheet. And they specifically look at one of the telling factors is how you custody it. So if you're custodying corporate funds and customer funds together in a public key address and segregated by the back-end system or whatever the case may be, that requires you to show it on balance sheet. If you're grouping customer funds together in public key addresses and segregated by the back end, then you need to show it on balance sheet. But of course, there were still ways to argue that it should be off balance sheet accounting. Interestingly enough, of course, I've been advocating on balance sheet accounting for a while now, but interestingly enough, the SEC in the United States came out and they said, well, if you hold assets in a fiduciary capacity, such as a cryptocurrency exchange or custody solution, you actually need to show that asset and corresponding liability on the balance sheet. And the big question, as you sitting here and me talking about accounting, is why is this important? Why would you even care about this whole topic about on or off balance sheet accounting? And I've got an example here on the right-hand side. So on the left-hand side, I've got off balance sheet accounting. On the right-hand side, I've got on-balance sheet accounting. So you can see there's an 850 million balance sitting there glaring at you. And if I come as an auditor in an off-balance sheet accounting perspective, and I look at the balance sheet, and there's no balance sitting there, there's nothing for me to audit. So no one is making sure that your digital assets actually exist, and that virtual asset service provider actually has control of your asset. And that corresponding liability that the fund of the virtual asset service provider actually owes the funds to the customers. And of course, the big question then, of course, from that is if you have an instance where your virtual asset service provider is performing this off-balance sheet accounting, are they actually doing a proof of reserve report? Is there an external party coming in and looking at those cryptocurrency to make sure that they exist and they are under the control of the virtual asset service provider? Now, of course, the other aspect to it is that glaring liability of 850 million rand sitting there. That creates accountability. So when a virtual asset service provider pulls this up the financial statement and it opts for on-balance sheet accounting, they know that they've got that liability, that responsibility to their customers. So I said we're going to touch on why regulations is needed, and I'm going to use this as a practical example as well. So everyone sitting here is familiar with the case of Mirror Trading International. I'm going to use this to demonstrate to you how regulations could have helped in limiting the amount of fraud that had taken place. So in South Africa, a South African company needs to be audited in certain circumstances. When your public interest score reaches 350, you hold assets in a fiduciary capacity in excess of 5 million rand, or your regulator essentially requires you to be audited. Now, of course, Mirror Trading International was sitting on millions and billions of rand, so they would have been scoped into an audit. But Mirror Trading International was incorporated on the 30th of April 2019 by the sole director and shareholder, Johan Steinberg, and they had a February year-end. So essentially, they had 10 months to conduct their business up until they reached their financial year-end. From the financial year-end, the Companies Act dictates that you need 6 months, then you need to produce audited financial statements that bring us up to the 31st of August. Of course, in South Africa, there's no monitoring agency to making sure that companies actually submit audited financial statements when required. So they could have carried on, and we all know November, December 2020, the House of Cards fell in. So there's a fair amount of time that passed for all this fraud to be committed and the funds to be misappropriated and all those types of things. And of course, for my dealings with the Mirror Trading International liquidation case, we've also found that there weren't any accounting records. They were simply using a purchasing sales system just to track the ins and the outs of what's happening on, just to basically keep record of customer funds to a certain extent. No accounting records whatsoever. But let's look at this as if they were operating in a regulated space. So 10 months, or incorporation, 10 months to the financial year end. Now, FSCA requires you to submit audited financial statements 3 months after your financial year end, which means that they would have limited the amount of fraud that took place up until the 30th of May 2020. So that's 13 months compared to 16 months and more. Now, of course, the issue with Mirror Trading International looks all too familiar. We saw that with the documentary on Netflix earlier this year, The Hunt for the Crypto King, and what happened with Quadriga. And it's exactly the same. The assets never really existed. No one made sure that the assets really existed. There is no third-party auditor coming in, looking at the digital asset. There was no proof of report done whatsoever. Of course, then the question is, over the last 12 to 24 months, what have we as Mazars also done to add credibility to the industry? So we were the first audit firm to issue proof of reserve reports for both Luno and Revex, and we continue to do this on a quarterly basis to make sure that provide the users of these platforms that their cryptocurrency actually exists. So we provide them with that reassurance. Of course, we've also assisted on various tax webinars speaking about cryptocurrency and tax. We've spoken about auditing of digital assets and virtual asset service providers, the need for data analytics. And of course, we still continue to service these leading and largest virtual asset service providers from a statutory audit perspective to make sure that we bring credibility to the industry represented by the Mazars brand. Now, tax. Everyone always wants to talk about tax. Even though if it's cryptocurrency or not, if you're at the braai somewhere, everyone wants to talk about tax and why they're not getting a larger rebate. So what I want to show you on the screen here is quite interesting when it comes to cryptocurrency. And sometimes this is difficult for people to understand. And this is where one of the contentious areas lie. People don't always necessarily understand the amount of transactions, tax transactions, that are triggered when you interact with cryptocurrency. So over here, we've got an example of Lara receiving 0.1 BTC as remuneration, tax event, that's taxable income. Then Lara goes and she sells, or she liquidates some of her BTC for real world money to pay for petrol. Liquidation, that is a tax event as well. There's another 2,500 Rand gain. Please excuse the Bitcoin, Ethereum prices. This example was done a while back. So then Lara decides, well, she wants to buy or use some of her Bitcoin to trade for Ethereum. Of course, barter transaction. Crypto to crypto is a barter transaction, another tax event triggered. For the base cost of your Ethereum, you need to keep track of the base cost of your Ethereum as well for when you subsequently sell that to determine what your gain is from that perspective. Then Lara goes and she transfers some of her Bitcoin to a Bitcoin debit or credit card, pays for a cup of coffee. There's no de minimis rule whatsoever in South Africa, so another tax transaction over there. So you can imagine, that's one day. Imagine if you had to keep record of all these transactions, what a nightmare it would be. Now, of course, there are tools to track this, but the issue is there's limited tools that work across platforms as well. So we've also gone out and we've sourced a tool that we've partnered with. So within Mazars' service offering, we can offer compliance work to those actually looking to complete their tax returns. The tool basically draws APIs on-chain transactions to essentially determine what your taxable income is. Now, so the theme of what I want to chat today about is what's happening in the crypto market over the past 12 months or 24 months. And the big question is what happened, what's changed in the income tax act over the last 12 months or 24 months? And the answer to that is nothing. Nothing has changed. SARS has merely stated to us the normal rules apply. So essentially that means SARS says the existing legislation exists there and you need to fit this asset class into existing legislation and apply existing rules. But it doesn't work like that. The technology wasn't designed for the current laws and regulations. There's still this big question on, is it income or is it capital in nature? And of course, SARS hasn't provided us any guidance on that. There's a massive misconception that if you hold Bitcoin for a period of 3 years, it's deemed to be capital in nature. That's not the case. You're referring to Section 9C of the Income Tax Act that relates specifically to listed securities. Cryptocurrency and digital assets isn't listed securities. So there's no clear guidance on that. Voluntary disclosure programs. We've been dealing with a hell of a lot of voluntary disclosure programs. So VDP is essentially, if you're in a situation where you've received gains from your cryptocurrency trade, but you haven't submitted it for the last year, 2 years, 5 years, 10 years, or whatever the case may be, you enter into a VDP with SARS and you say, well, my bad, I need to correct this in my tax returns now. And what essentially happens is SARS waives all those penalties and quite hefty penalties that can be levied. But of course, important to remember, once SARS asks you a question about you possibly not declaring income, the VDP is gone. You lose that ability and you can be fined up until 200% of your taxable income. So that's why we've been dealing with a lot of clients from a VDP perspective. Sharing information. So it's been in the news a couple of times of virtual asset service providers sharing information. But this happens all the time. It's required by the Tax Administration Act for virtual asset service providers to share information. And I can promise you, no virtual asset service provider out there is going to put their neck on the block and say, well, they're not providing information to SARS when requested. So just be wary of that. The other misconception out there is how you're taxed. So there's a lot of people that believe, well, I'm going to buy cryptocurrency on Kraken, I make a profit there, it's outside of the boundaries of the Republic, so I shouldn't be taxed on it because it's in the US. You, as a South African resident, South African taxpayer, are taxed on a worldwide basis. Meaning, doesn't matter where your source of income is coming from, you're taxed on a worldwide basis and you pay tax here in South Africa. Crypto to crypto transactions. Of course, we mentioned that in the example as well. Crypto to crypto is a barter transaction. There's this misconception that a tax event is only triggered when you liquidate. Not the case. Barter transaction, you need to pay tax on that crypto to crypto transaction. Of course, the record keeping we spoke about, this is an enormous headache trying to manually keep record of these transactions. So rather use a tool, come and have a chat to us, and we can see if we can assist. The other topic that I want to chat about is further innovation in the industry. What have we seen over the last 12 to 24 months in terms of further innovation? So the market was dominated by OTC desks, investment platforms, exchanges, arbitrage platforms, and not really a lot else. But slowly but surely, we see the development of new areas and new type of products coming up. Now, if we look to more developed markets, and for the first time, that actually includes South Africa as well. If we look at the US, look at South Africa, look at Singapore, you look at the innovation that's coming through. We're seeing these listed investments. In the background, I'm fortunate enough being an auditor, I've got clients coming to talk to me. In the background, plans are happening for when regulations change so we can have these listed securities that hold cryptocurrency as the underlying asset. So we've seen slowly but surely that happening in the background. Funds with master feeder funds, of course. We've seen a lot of custody solution, investment products, including DeFi. DeFi, extremely wide topic when you talk about DeFi because there's various other, we call it subsectors of DeFi, a lot of new products there. In South Africa, we've seen one case of ATM, Bitcoin ATMs. It's more in the more developed countries such as Singapore and the US. Tokenization of assets, of commodities. We've seen tokenization of things such as hydrogen gas as well to essentially to generate capital and create a spot market for those types of commodities. NFTs is still on its go. And of course, cryptocurrency and digital assets as a whole basically forms the foundation of the Metaverse and Web 3.0. And there's, of course, a lot more development coming from that point. One of the other areas that we want to chat about what's happened over the last 12 months more is what's happened in terms of NFTs, non-fungible tokens, decentralized finance, and stablecoin. So NFTs, I've got the guy that bought Jack Dorsey's tweet for $2.9 million US. When it went on subsequent sale, you couldn't even get $3,000 for it. So that novelty of those type of gimmicks are wearing off. NFTs seems to be moving towards a place where it's more made for digital artwork, the more tokenization of real-world assets to a certain extent. And of course, NFTs have taken a beating when it comes to the bull market. We learn to read our terms and conditions. We read your terms and conditions when you invest into a product. We saw what happened with Celsius. We learned what the word rehypothecation means. We learned what the word credit a counterparty risk means. Because essentially what happened with Celsius as well is they had that rehypothecation take place. They had that counterparty risk. But the individuals investing in them didn't necessarily understand that risk imposed of it. We saw with stablecoins. We saw with stablecoins exactly what the difference is between fiat-backed stablecoins and algorithmic stablecoins. And fiat-backed stablecoins aren't always as safe as you expect it to be as a result of rehypothecation. Look at that Tether, for example, how they were fined last year for that element of not holding those assets and being collateralized. So again, back to what we've seen. Of course, we've seen the Ethereum merge taking place. So we've moved essentially from that proof of work to proof of stake. So it's a step in the right direction in terms of ESG. We've seen the tokenization of carbon credits that's also making waves. Of course, clean energy. We've seen in Australia, UK, where they utilize smart contract technology to essentially pump back electricity into the grid and actually sell that to the person next door. So there's a lot of innovation taking there from there. CBDCs is always a talking area. My point of view on CBDCs, I'm not sold. Andreas Antonopoulos always says, when you're looking at something from a blockchain perspective, determine whether it's revolutionary, immutable, public, collaborative, open, resistant to censorship, and decentralized. And I'm not sold, unfortunately, that CBDC covers that. So what you have essentially is a central ledger that's just controlled by one party. So a very expensive ledger at the end of the day that you have. We saw the Central African Republic being the second country to accept Bitcoin as legal tender, which is fantastic to see. We'll hopefully see that more countries adopt that in the next 12 months. So the big question is, where does this leave South Africa? So from my perspective, what I've seen is we've seen that legacy businesses, or rather cryptocurrency, is spilling over into legacy businesses. So I'm dealing with manufacturer and retail businesses that are selling goods overseas. They're accepting payment in stable coins, because why not? Why would I wait 7 days for my cash when I can have it in the same day when using stable coins? So from payments and receipts perspective, there's a lot happening in South Africa. The payments and the cross-border payments and remittances is a very interesting topic, especially in South Africa. What I've also seen is normal businesses actually holding cryptocurrency on their balance sheet. So normal businesses actually buying bundles or buying Bitcoin or buying Ethereum, holding it on the balance sheet to hedge themselves against a devaluation of fiat currencies. Mazars, of course, being a global firm and in Africa, we've got a big presence in Africa. And what we've seen is South Africa has been the entry point for these virtual asset service providers into Africa. So we continue to service those guys operating from Cape Town or South Africa and moving up into Africa. But of course, one of probably the points that I want to leave you with is all of this will only be possible if regulations do not stifle innovation. And that's one of the key things that those trendsetters or the lawmakers needs to look out for when imposing these laws and regulations. That's it for me. I hope you find that insightful. We are here the whole day. I am joined today by my colleagues. I've got Mia is here. Well, she's a fintech specialist of ours. We've got Sean as well. He builds sector focus within Mazars. My managers, we've got tax consultants out here. So please drop by the stand if you want to have a chat.
Wiehann, baie dankie. Thank you so much. Anyway, thank you very much,
Thanks
Wiehann.
so much. Appreciate it.